Hi, this is Jim Cunningham. We're going to talk about inheritance planning. Are you ready to inherit? Now, you might think, Jim, that is the dumbest thing I've ever heard. Am I ready to inherit? Don't you just get a check? Doesn't it just kind of happen automatically? Absolutely not. There's lots of stuff going on. We cannot forget about taxes, not just estate taxes, not just state death taxes. There might be a generation skipping transfer tax. We'll talk about that. And a biggie, a big hidden one is income taxes and also capital gains taxes. So depending on how the estate is structured, depending on what the assets are in the estate and what sort of planning's been done before death, that really can affect the outcome. And this is something as a person who, if you're watching this, you might be the person who's inheriting, you might be the person seeking peace of mind so that when you pass away, are your people, are the people you care about that you want to leave your assets to, are they ready? We're going to talk about that. So very, very important topics. If you're watching this on YouTube, please subscribe to our YouTube channel, and then it'll pop up in your feed. These videos, we post these videos about once a week, typically Thursday at 6 p.m. And really, do you know inheriting assets can significantly impact your financial future? I've got Christina Lindsay joining me here, and we'll give you a little bit of an intro in a couple of slides. But Christina, what I see a lot of people happening when they inherit, this inheritance really kind of funds many people's retirement, right? So people are inheriting typically in their 50s and 60s. Not always. I met with a client recently who inherited a significant amount of assets in his 20s, unfortunately. But most people are inheriting typically around retirement age. And we do see, it's kind of a pattern we see, is some people can retire once they do receive that inheritance. And so real estate annuities, large retirement accounts, those can impact your financial plan, your financial planning. And a lot of taxes come with that. So a lot of times people really aren't thinking, gee, if I inherit real estate, my property taxes might go up. Well, in California, since, passage of Prop 19, that's going to happen. Annuities, spoiler alert, if someone puts in $100,000 in an annuity and it goes up to $1,000,001, that 100,000, that first 100,000 that comes out, you're not paying taxes on that. But that gain of $1,000,000, the beneficiary, the person who's receiving that money, does pay income tax on that entire $1,000,000, typically in a year. There is a workaround that Christina and I will be talking about. Estate tax consequences, as we're doing this in February of 2025, things are really up in the air in terms of what the future tax regime will look like. There's talk of a big Republican tax bill getting, going through. That has not yet happened as the date that we're recording this, but we are paying close attention to it. And really, it's all about preparation, a lot about knowledge. A lot of this stuff, if something bad's going to happen, I want to know. If taxes are going to be owed, I want to know. I don't want to just be caught unawares. So these are the things we're talking about. I'm Jim Cunningham. I've been an attorney for 30 years. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law. And I am working this week on the questions for the certified specialist exam. So I'm part of that program that certifies lawyers in the area of estate planning, trust, and probate law. I'm also a real estate broker, securities, and insurance license, and a pilot single engine land instrument rated, third generation, the only one not to crash a plane in my family. No one died when they crashed their plane, so that's good. These are the attorneys in our firm. We're dedicated to all things estate planning, the peaceful transfer of wealth with minimum taxation from one generation to the next. And Christina Lindsay Orta is joining us from Ascent Wealth Management, and she is one of 3 certified financial planners at Ascent Wealth Management, and they help a lot of our clients and a lot of other people's clients with financial planning. So I will let you talk, Christina, I promise. This is a disclaimer. I'm a lawyer. I'm talking. Words are coming out of my mouth. This is not legal advice, okay? Legal advice is one-on-one, and feel free to reach out to us to schedule a time to speak with, either myself or another attorney in the firm. And you have a disclosure, Christina. We'll talk about your disclosure. Then I will hand over this mic that I'm so reluctant to give up.
This is our disclosure. We do have an affiliation with Cambridge Investment Research. That is our broker dealer. We also are a registered investment advisory firm registered with the SEC. This is our standard disclosure that this is not investment advice. This is not a recommendation of any kind, and any investment advice is given on a personalized individual basis with a fiduciary standard. We are a CFP-only office, so we are held to an even higher fiduciary standard, and any advice is on a one-on-one basis. So this is just for informational purposes only.
Well, what sort of things do people inherit? What I don't see on here are timeshares. So sometimes people want those, but many times we could do a whole topic on timeshares, but let's
Yeah,
talk
that would
about
be
the,
honestly, that would be a really good webinar because I think that there's a mixed bag of whether people want those or
yeah.
not.
How do I get rid of how do I get rid of that lot in California City that I bought, years and years ago?
Yeah.
For you Southern California people. So let's talk about it. Real estate, business interest, retirement accounts, investment accounts, life insurance, annuities. There's a gotcha in there. Living
Yep.
trust, personal property. These are all the sort of things that you can inherit. And really, I think your focus as a certified financial planner, which is a CFP, you're going to be focusing on a lot of these, and also on real estate too. We cover that in other webinars, surprisingly, because you really do need to look at that real estate. If you inherit real estate and you go, "Gee, mom and dad had this low Prop 13 taxes. Now the property's reassessed. I do get an adjusted cost basis when mom and dad die, so I can redepreciate." But does that math add up, and does this investment might have made sense for mom and dad, does it make sense for me? So these are all the kind of things we're going to be talking about here.
Yeah, so it really is important to truly understand like what of these different things would you be potentially inheriting? Because a true financial planner, now there's also just different kinds of financial planners and investment advisors or investment brokers or insurance brokers or insurance agents. And so when we're dealing with the realm of inheritance and components of an estate, it's also important to truly understand what is it that a parent or a loved one who you might be inheriting from, what is it that they own, and what type of investment advisor, to the extent that they had one, were they do it yourselfers, did they have anyone looking at everything comprehensively? In our office as CFPs and doing everything truly holistically, we're not just investment brokers or advisors, we're doing comprehensive planning. So we're looking at every aspect of when a client is set to inherit or what they're planning to leave as a legacy. We're looking at real estate, we're looking at titling, we're looking at all the retirement accounts, annuities. Sometimes that's a real component we'll talk about a little bit more that requires planning pre-death. There's also some planning that can be done post-death. So those have some additional complexities. Business interests are critical. And this is really where having someone that's looking at everything comprehensively is important. So let's kind of get into the details of specifically tax-deferred assets. So there's really two types of tax-deferred assets. That would be retirement accounts, 401ks, profit sharing accounts, IRAs, 403bs, 457, deferred comp. All of those that kind of fall in mostly that ERISA retirement plan or IRA bucket.
Yeah, Christina, there's a lot of acronyms in here. Tax deferred. If I were listening to this as a layperson, someone with not a lot of technical background, I would say, what does tax deferred mean? I would say, broadly speaking, these tax deferred assets, what that means is any income or any return that the investment has in a given period of time can be taxed. Those taxes on that can be deferred. So if you have an IRA, that if you're not taking minimum distributions, if you have you buy Nvidia and it goes way up and then you sell it, you're not paying capital gains tax. That's captured in that IRA. It's only when you take money out of that account. And I would venture to say that tax deferred asset, every tax deferred asset has a beneficiary attached to it. These tax deferred assets typically are not titled in your living trust, potentially the exception of an annuity, but titling an annuity in a trust is very problematic. But I would say, just from a reference point, think of these tax deferred assets as assets that are not inside of your living trust, that bucket with a handle. These are assets that exist and pass outside of your living trust. So they typically have a human being attached as a beneficiary. So that's what we're talking about here. Who is listed as beneficiary? Can you list your trust? Can you list your estate? Yes. I would say most people, Christine, are listing people, right?
Most often not, for specific reasons. And that's really when it comes to couple things. When we're dealing with an IRA, you could have an IRA trust named as a beneficiary, which the IRA trust typically doesn't go into effect if you have a married couple. The surviving spouse is going to take it as a spousal IRA, and most often, not all the time, but most often. And then contingent after that would be the IRA trust goes into effect after two spouses, if there is a couple have passed. That being said, a non-retirement trust, most often we would not want listed as a beneficiary, because it then does not provide that individual the ability to do a stretch out of distributions over the 10-year rule post Secure Act.
Yeah.
So,
So what we're talking about is when you inherit an IRA, you have a few options. Number one, you can take all the money out and pay the tax. Now, for a lot of people, if it's a $2,000 IRA, probably not worth doing any planning. You're not, nobody cares.
right.
If it's a $2 million IRA, that's a big deal because if you have a $2 million IRA in California and you take all that money out, you're going to pay $1 million in tax. Now, depending on if the person who passed away, if that person was already hit their minimum distributions, but typically over age 73, you as the recipient have to take a minimum distribution for 10 tax years. Then in the 11th tax year, so the year that contains the 10th anniversary of the death of the person you inherited the IRA from, get your head around that. That's when all the money has to come out. So that 2 million could go to 4 million, and now you're paying 2 million in tax and putting 2 million in your pocket, having waited 10 years versus inheriting a $2 million IRA that has not grown right in year one, and you get $1 million. So very important to understand that passes by beneficiary designation, not through the living trust, and there's a huge tax issue, which means potentially taxes paid.
Correct. Yep. So making sure that you're not listing a trust is key. I think that this is something that we don't see as often as we used to. I think that the investment advisory world has done a better job with this, but it is still sometimes something that we see. It could also be that there has been a death in the family, and maybe sometimes there's two deaths close to each other. Making sure that beneficiary designated assets, such as IRAs and annuities, that those beneficiary claim forms and designated beneficiary forms you're looking at those sooner rather than later, because we've seen sometimes where, there's no update. The next person in line has recently passed. So looking at beneficiaries is important. And those sometimes could be good assets. If you have a large, the beneficiary that's inheriting, if they have a large estate themselves, and they're inheriting additional tax deferred assets, and they're in a high income tax bracket themselves, they're in their high income earning years, it may be better to have those go to the next gen and name potentially grandchildren or beneficiaries that could be charitable assets or charitable beneficiaries that aren't going to pay taxes at all. So retirement assets in and of themselves, those have a little bit of complexity. Annuities have quite a bit more complexity. And so we're going to dive into that a bit more. But there is such a thing called a post-death 1035 exchange. So you might have heard of 1031 exchanges with respect to real estate. A 1035 exchange is going from a life to life, a life to annuity, or an annuity to an annuity policy. So in annuities that are not retirement assets, so if it's not you could have an annuity that is a retirement asset as well, which would automatically, most of the time, a traditional retirement account would be tax deferred. I'm talking about the non-retirement annuities, that is non-qualified, non-retirement assets. So if you put in $100,000 and it's grown over the years and it might be worth $500,000 today, all that bucket of growth, that $400,000, has not been taxed. It is tax deferred, meaning at some point when that money comes out, it's going to be taxable. That is an asset that does not get a step up in basis upon the decedent's passing. So it is something that will have a tax implication to the recipient beneficiary. So I kind of want to dive into that a bit more. And I think we've got some slides that go into that.
I'm going to explain what's going on. So if you kind of got that, here's the deal. We're not talking about annuities inside of IRAs, different deal. What we're talking about is someone who says, gee, I'd like to put, $100,000 with Lincoln Financial, whatever, just pick some company. They give that $100,000, they write a check for $100,000, they get that annuity, and that goes up to $500,000 in value. That $400,000 increase, somebody, someday, is going to pay income tax on that $400,000 increase. That is different than if you buy a condo for $100,000 and then that condo goes up to $500,000 in value. If that's included in a deceased person's estate, the recipient gets that $500,000, doesn't pay any income tax on it, doesn't pay any capital gains tax on it, because you get that adjusted cost basis. So that's the difference. I would say the kind of big difference in the estate planning space. of having an annuity versus everything else. So when we hear qualified asset, when we hear tax deferred asset, I know my ears perk up. I know your ears perk up, Christina, because there are a lot of weird arcane rules that cover this. And there are some ways to really rescue this built up tax problem in someone's estate so that when somebody goes to inherit, they're not necessarily taking that $400,000 all at once in 1 year, which is kind of what normally happens. It's really the exception to do something
Right.
else, which is what you're going to be talking about.
Right. And we'll talk about the annuity component here in a little bit greater detail because there are some ways to plan for that. But before we do, I think it is important just to re-highlight kind of what happens to an IRA because there's been quite a few changes. There was some changes in 2019 with the Secure Act 1.0, some additional changes that recently took effect and are still taking effect with the Secure Act 2.0. And with the beneficiary rules, again, an IRA or a 401k, an employer retirement plan, is a designated beneficiary account. So the named beneficiary can either be an eligible designated beneficiary where the stretch out can still apply. So if you were a spouse and you treat this as your own IRA, you can continue to take required minimum distributions or tax defer that over your lifetime. Now, if it's a minor child, that's the decedent, they also have a stretch out capability. If it's a disabled person or a special needs person, they also have a longer time to deplete that asset. And so there are certain types of trusts, special needs trusts and such, that you can do that whole stretch out over the lifetime where you're not limited to the new 10-year rule. Now, if it's a non-eligible designated beneficiary, meaning it's not a spouse, certain trust, they're subject to the 10-year rule, meaning from the date of death, you have 10 years, 10 calendar years that account has to be depleted. And so you can take some money out at any point in time and pay the tax. If the account owner was of required minimum distribution age, meaning age currently in today's market, 73 or older, that becomes 75 in a couple of years. But if the owner died and was already subject to required distributions at age 73 or greater, then there's an annual distribution required to be taken over that 10-year time frame. And that has started this year. So this is the first calendar year that you are required to take out a distribution, and you are subject to the 10-year rule that account has to be depleted. So you can let it grow tax deferred, and at the end of that 10 years, you can take out however much you want to, but you should have a plan in place so that you don't have this ticking tax time bomb that all of a sudden at the end of year 10, you've got this huge income tax liability. So having a proper plan of how to take those assets out is important. You can also have a non-designated beneficiary. And charities are an option. You could name your estate. If you had your living trust, you could be subject to a 5-year rule. So you don't have 10 years to allow it to accumulate and percolate and stay tax deferred. You're subject to a shorter time frame. And obviously charities is and the most optimal for avoiding tax because there would be no tax to a charity on that asset. So these are all of the kind of newer rules and different options when it comes to beneficiaries.
I guess the takeaway from this is so incredibly complicated. As you're going through this, I spoke on this recently at a conference in Napa. Um, there are almost 300 pages of IRS regulations that came out last year on this. This is like the 60,000 foot level. If this is totally confusing to you watching this or listening to this video, that's okay. All right. You just need expert advice when someone dies who owns an IRA and you're inheriting that IRA. So don't just run out and do a bunch of stuff. You really do need competent advice from really a savvy lawyer, savvy certified financial planner. Somebody who says, hey, let's pump the brakes. Let's take a break. Because a lot of this stuff, you can't pull the cream out of the coffee. If you do certain things when you inherit an IRA, there are no like bumper guards. Like when you go bowling and you put up the bumper guards, when you're alive and you're dealing with an IRA rollover, they give you a little bit of grace. There's no grace when it comes to death. They're very draconian rules. And if you blow it, you can have a significant acceleration of a tax bill. So
that's correct.
Let's talk about 1035 exchanges. We are talking about
Yes.
IRC, Internal Revenue Code. This is a phenomenal opportunity. really don't hear anyone else talking about this, Christina. I listen to a lot of people. I pay attention to the ether. I listen to a lot of podcasts. No one's talking about this, and I never know why. Why aren't they talking about it?
It's a very underplanned for segment. Now, what we're talking about here is post-death 1035 exchanges. There are some options to also set this up prior to the current annuity owner. If the annuitant is age 90 or younger, then we do have some options to plan for better tax control to the beneficiaries and allow the beneficiaries a lifetime stretch out. So while we're going to highlight post-death, there's some nuances of this that if you know you're going to inherit an annuity and the owner of that, the current annuitant that owns that contract is 90 or younger, there's some things that we can do prior to death. So planning for inheritance and also things that we may be handcuffed, we can do post inheritance. So the number one thing that I think is often overlooked is you're dealing with a death, and there's the emotional aspects of that. You're burdened with all kinds of claim forms and administration that has to take place. Oftentimes people start filling out those forms and not really understanding their options. So it's important to just really truly have someone you're partnering with that understands how to be tax efficient. Because if you have this example where we've got principal and gains. So in this example over on the left-hand side of the screen, oops, sorry. There we go. We've got that principal and gains. If, for example, you might have had principal put in there, I'm going to use the example of 500,000 and $1 million. So you put in $500,000 of principal maybe 20 years ago, and you really haven't taken money out. It's been growing tax deferred. It's now worth $1 million. All of that gain that's baked in, if you think of this as a cake and the principal's the cake, the gains, the frosting, you've now got this whole pot of 500,000 of frosting that has not been taxed ever. As soon as you turn the spigot on to take money out, whether it's inheritance or whether it is money you're taking out during your lifetime, most of the tax treatment in the Internal Revenue Code is LIFO, meaning the last money that was gained in the contract is the first money to come out and get taxed. So the IRS wants to tax that frosting before they get to the principal of the cake, and the cake is never taxable. Whatever you put in as principal is never taxable. But
For income tax, it's taxable for
income
tax purposes,
taxes.
but income tax,
This is
'cause you have
still part of
basis,
your
right? You have
gross
basis,
estate.
right? You have basis, yeah.
Yeah, this is still part of your gross estate,
Right.
but there is no step up in basis on an annuity. And it's not treated as capital gain. It's treated as the highest taxable ordinary income. So if that is how the tax treatment is going to work, if you were to just do the claim form and take that check, you could be paying a significant amount, as much as 53% of tax on that $500,000 of gain or frosting of the cake. Now, there is an option in the tax code with certain types of annuity structures to do a post-death exchange from the current carrier of the annuity. Could be XYZ company. We can exchange that to a specific company that has the right code with the IRS and private letter rulings and the appropriate tax treatment to change that tax treatment so that we can turn that cake and have it, rather than being taxed the frosting before we get access to any of the principal, we can slice the cake and pay a little bit of tax a little bit at a time, to where we're having what we call an exclusion ratio. So if 50% of that account value, that $1 million, 50% is gain, 50% is principal, and let's just say we take out $100,000, it allows us to slice the cake to where we're paying half of the tax on only what is gain. So if the ratio is 50-50, that 50,000 is going to be taxable, 50,000 is going to be principal, not taxable. So it just allows us to have the option to take that cake, let the continued gains continue to bake in, and we can have that, whatever the account value grows to is still tax deferred. We're not paying a dime of tax till we take it out. We can even apply a life stretch out to the beneficiary where they can take it out whenever they want to, but they have the option to let this grow over their entire lifetime and let it keep growing tax deferred and just take a little bit out at a time.
Yeah, I mean, I probably the most ham-handed worst way to do this is just fill out the beneficiary claim form, take the annuity, put the money in your bank, and then it's like, now you got, in your case, a $500,000 added to your income. And in California, it's going to be over 250,000 in tax, most likely. So half
Most
of that's
likely.
going to tax, right? Half that gain.
Correct.
What we're talking about here is taking it out over a significantly long period of time. And what happens is that money that would have otherwise been paid in tax, that 250,000 of that million that would have been paid in tax, is invested in the annuity, growing and giving you a return. So why, I mean, that's a no-brainer. Why wouldn't everyone want to do that? I mean, and why don't people do this? I think they just don't know, right?
Yep. There's also a way to possibly take this out of the estate. Like I said, if we can catch this prior to a passing, there's a way to gift some of this out of the estate. We did have a client case where the annuitant and account owner lived in Washington State, which has a very high death tax if you have certain
Yep.
things to your name. So we were able to honestly transfer the annuity to the beneficiaries prior to passing and give them a lifetime stretch out and remove it from the taxable state of Washington. So there's some things we can do with this. If you are planning for inheritance and you know about it prior to death, that would be something that we would want to talk about, especially when there's complexities with annuities. But there's also things we can do post-death. So this
Yeah.
is
And also, to be clear, what I'm hearing is this is where somebody comes to you and they say, look, I have this annuity already. This is not where, like, hey, you're not suggesting that people buy an annuity. This is a situation for people who already have an annuity
right.
and they have this built-in gain, which is a tax problem. That frankly, this is one of those things. I got to tell you, I've been doing this 30 years, Christina. This is one of those things that falls between the cracks of estate planning attorneys, financial advisors, and CPAs, because I
Yep.
think all three people need to come together and pay attention and work through this issue, because I think it does involve the three professionals. And sometimes it's, the parents' professionals and then the child's CPA professionals. So it's potentially a larger group of people.
Exactly. Um,
Illiquid assets. What does
yeah.
that mean? What's a liquid asset, Christina?
Liquid would be cash, CDs, stocks, bonds, IRAs, mutual funds that are in an IRA, anything that is transferable. Illiquid, and I guess you could argue cryptocurrency is still a form of liquid. You could turn it into cash, but real estate, business interests, personal property. So real estate, if an estate tax applies, anything that's illiquid. So if you've got business interests and you own shares of a corporation or a family business, or you have a value to that, you could have an estate tax applied. So if you are over, what is the current estate tax limit today, Jim?
13,990,000. I don't know why they didn't round it up,
Just
but
shy of
yeah,
14
14
million.
million. We'll just
So
round.
if you have a value to everything that is exceeding that, and you don't have a lot of liquidity, for example, if you have only $2 million of cash, CDs, money market, stocks, and bonds, and you've got $16 million worth of real estate, and you've got an estate tax due, you need to make sure that you've got enough liquidity in your estate to pay that estate tax without being forced to do a fire sale of assets. So there's some planning involved. Is there going to be an estate tax due? Is this real estate that you're going to want to sell, hang on to? Are there multiple beneficiaries where you have to deal with, okay, I'm one of three beneficiaries. I want to keep this as a rental. I have to buy out other siblings.
My
How do
jerk
I,
brother. You got to buy out the jerk brother.
yeah, how do I pay for that? Do I have enough capital from
Yeah.
my own estate or what I'm inheriting to do that? So you have to have a plan. How does that impact your overall retirement plan? Is there a 1031 exchange possibility? So how is title held kind of really folds into this? So there are some cases, very, very rare. I happen to be dealing with two of them right now, which again, these are so rare. The fact that I'm dealing with two of them at the same time is very rare.
You're special,
But
Christina.
you have we have some situations where kind of the biggest no-no, and unfortunately we see it with people that have kind of been successful or done it themselves for years. They might happen to put real estate in a corporation,
Oh,
an S corp or a C corp, and
yeah.
for all intents and purposes, that's a big no-no. So that's step one. You really don't want to own real estate in a corporation.
Unless you have to. I mean,
Unless you have to.
unless you're a foreign resident who owns property in the US, there are limited use cases, but it's a problem.
It's a big problem. And when you do a conversion of a corp from a C to an S, there's a 5-year wait period. It doesn't matter if there's a death in between. And so I've got two situations right now where they're not past that 5-year period of time. They're not wanting to continue to own and manage all this rental real estate. So we're looking at a 1031 exchange because that is an asset. Whenever you have real estate holdings within a corporation gets a step up in basis on the stock. They do not get a step up in basis on the value necessarily of the real estate.
Yeah,
So
the underlying assets. So as a shareholder, if those are included, the shares are included in your estate, you get basis
correct.
in the shares. So if you have a property worth $1 million with a $50,000 cost basis, and it's in a corporation and you own those shares, when you die, your basis goes to $1 million, which is the value of the shares. But if that corporation sells that property, it's going to be subject to capital gains tax. And there's a way to unwind that after death that we help clients with. So
Yep.
if you're going to inherit property, real estate, you need to pay attention to title, which is what you're talking about. If it's in a corporation, you need to really start paying attention to that now
Yes.
before the person passes away.
As much as possible. So this is really where, to the extent that we can plan for inheritance,
Right.
understanding the title is incredibly, incredibly important. Is this real estate you're going to want to own, manage, maintain, do all the maintenance for, put all the capital intensive cost into, or do we have to look at a potential 1031 exchange because there's not going to be an opportunity to have a step up in basis or we're time constrained? So 1031 exchanges are a possibility. And if it is something that's going to be maintained as a rental, will Prop 19 continue to keep the property tax base low? Maybe this is an asset that once the property tax gets reassessed, doesn't have the proper cash flow to warrant holding that asset.
Right.
And that's where having a team do the proper analysis. What's the cash flow? What's the rate of return? What's the cost maintenance? How does that impact your long-term retirement plan? So it's a little bit more nuanced than just, oh, this is a good cash generating income asset was for my mom or my dad or whoever I'm inheriting this from, but it may not be that same way for you.
Yeah, and it's important to know if your estate is illiquid, and the IRS defines that as 35% of the assets of an estate. If 35% or more of the assets of an estate are what are called illiquid, it qualifies you under Internal Revenue Code 6166 to enter into an installment agreement with the Internal Revenue Service to pay those death taxes over 10 years instead of paying them all in 9 months. So death taxes are due 9 months after date of death. So a very simple example, let's say mom has a $114 million estate. It's because the math is easy. 14 million passes tax-free, $40 million tax bill on that remaining 100 million, $4 million a year plus interest would be due to pay the tax bill. And that gives you time. I mean, you still have to pay the tax bill, but the idea here is it gives you time to have an orderly liquidation or partial liquidation of assets without having to go through that fire sale. So again, that's one of those things. If you have an illiquid estate, you need to be paying attention to this. You need to timely file your death tax return, your federal estate tax return, and make those proper elections. And that's why you need the CPA, financial advisor, and lawyer who really understand what's going on. And a lot of advisors miss this stuff, and it's kind of low hanging fruit.
Right. Life insurance considerations. Who's listed as the policy beneficiary? I can't tell you how many times that this just is something that like you set it, forget it. And especially if it's a paid up policy that you're not ongoing paying the premiums, you're not thinking about it. It's old, it's paid for, I have it. People don't look at the beneficiaries.
Yeah,
They
no,
just,
Chris, where would we look? When you say it's listed, do I look in my living trust for that? Do I look on
no,
what's
honestly,
the best thing to do?
the best thing to do is to get confirmation of that beneficiary from the insurance carrier, have something in writing. Some insurance statements have it listed, some do not. So sometimes you might look at, here's my life insurance statement. It says that here's the date I got it, here's the death benefit, here's the cash value. It doesn't always list the beneficiary on your statement. So you'd have to get confirmation from the insurance carrier. Who do you currently have listed? Get that in writing and have it be a policy to check that every so often and make sure that you're doing maintenance every 5 years, or if there's been an event or a death in the family or a change to the trust. I'm in the process right now of irrevocable life insurance trusts. I'm looking at changing the trustee of those trusts because we've got an older individual that will probably not outlive the policy. So we want to have that trustee of that trust become a corporation, like a corporate trustee that we know will be there to help us fill out the claim paperwork when the insured person does indeed pass away. So understanding, is there a life insurance trust? Who's the current trustee of that trust? And is the policy performing? So meaning this could have been a policy that you did 20 years ago when the estate tax limits were 3 million per person. And you go, gosh, I know my kids are my estate's probably going to be worth 5 million or more. They're going to pay $1 million in estate death tax. I'm going to buy a policy to help cover that tax. There's a lot of policies out there that are older that maybe were designed to perform at a certain level. If there's not enough cash value to cover that death benefit, or if that insurance company might be at risk of going default, we need to look at, is that insurance carrier still solvent? Is the policy still performing? Meaning, do we have to throw some additional capital into it to maintain that death benefit? Or do we need to reduce the death benefit because there's not enough cash value in there to maintain the death benefit? So this requires, coordinated effort to look at these things and do a proper, analysis every now and again.
Yeah, and I think the legal technical term is if everything goes wrong, the policy blows up, which means it just kind of goes away, and you may get stuck with an income tax bill because it becomes a modified endowment contract. So I'm just throwing out a lot of, legal mumbo jumbo to remind, if you're listening to this or watching this and have life insurance, please pay attention to it. And you can work with someone like Christina to help you through that. But this is something absolutely you should pay attention to. And we have seen very recently one of these policies blow up, or the family paid in for years and years and years. And because they weren't paying close enough attention, well, the insurance company actually went under, didn't it?
Yeah.
Yeah. So tough situation.
It became a state insurance settlement where the most that the death claims could pay out, even if you had $1 million policy, the most that they were allowed to pay out was 300,000 because you had a receivership that the state had to go in and take possession of the assets.
Yeah. So yeah, insurance is all state by state. So if you buy it through, Nightlife of Kansas, that's regulated by the state of Kansas. And it's very important to get a reputable quality life insurance company. And that's why it's important to check on the health of the policy to make sure it's guaranteed it's going to pay out if you reach 90 or whatever, age it is, 95, something like that.
Mm-hmm. And then a life settlement option. These are so rare. They are not something that we see often. I'd say more often than not, they're not in the best interest of the client.
Yeah.
That being said, it is something that, if you've got like a hefty premium that you have to continue to pay for maintaining a death benefit, and it's just, you've paid all this money into it over the years, and you don't want to continue to have to pay into it, but you want something in value for what you've paid in. We can look at that. Or if you know that you've don't need the policy, we could possibly look at selling it. Or if you've got a terminal illness, could we get some value out of it now versus having to wait till death? So these common considerations, if the premiums are no longer affordable, if you no longer need coverage, if you need to fund other costs, it's worth looking at if you're planning for inheritance and what are the options. But it does require, proper care coordination and not working with just an insurance broker that might be looking to sell a policy.
Yeah, we covered this in other webinars. Sometimes, if you're watching this and you're thinking about your parents, or maybe you are the parent and you're getting older, sometimes people can take an old policy that, they may have bought a policy a long time ago that's got some cash value in it. You can do a 1035 exchange, which is a tax deferred exchange, and you can take your life policy with its cash value and buy long-term care insurance. And that's something that you could talk to Christina about doing. But I've seen that happen with several of my clients who have said, look, I have this life insurance policy I got a long time ago. I don't really need it, don't really want it, but I was thinking about getting long-term care insurance. And you can just repurpose that asset to get long-term care insurance in many circumstances.
Mm-hmm.
Well, let me see if I can keep the slide here. Trust administration considerations. So it's very important to update your trust documents. So a living trust is I mean, the document's not alive, it's a piece of paper, but it's for a living person. And in our lives, things change. And I know as my children have gone from, uh, grade school to high school to college, and now they're in their in the adult world, things change. And we used to not name, we have different people named to handle our estate 15 years ago than we do today. We have different concerns. Who will my kids marry? Will their marriages be successful? Will they not be successful? And that's one of the things as people age. As you age, you have marriages, births, deaths, divorces. Updating those trust documents becomes very important because an outdated estate plan can be a significantly more of a headache, literally, than no estate plan at all. So outdated could potentially have significantly more problems. Retitling of accounts, you want to make sure that, if a living trust is a bucket with a handle that you hold on to, you're the trustee of your living trust, you're holding onto that handle. Into the bucket goes your house, your stocks, your bonds, your mutual funds. The way you do that is by changing titles. So you got to do a deed if you have real estate, right? You're going to have to change a title. If you have an account with Christina, you're going to have to change the name from your individual name to your living trust on a lot of assets. This, of course, does not apply to IRAs, 401ks, 403bs, tax sheltered annuities, typically annuities and life insurance. So stay out of your living trust, broadly speaking. Updating beneficiaries. So those things I just mentioned, the 401k, the life insurance, you got to nail down who that beneficiary is, because it does not matter what documents you have in your safe or your safe deposit box or the documents that are at your attorney's office that you signed. What matters is the documents that the insurance company or the IRA people, the IRA custodian, what documents do they have that say, look, when someone shows up with Jim Cunningham's death certificate, who gets that money? And I'm telling you, they have an answer. It's either going to be the people that are named on a beneficiary designation or my estate or whatever. It's going to be, but that money's going to go somewhere. It's not just going to go away. And adjusted cost basis. So when assets are included in a person's gross estate, the general rule, gross estate meaning if it's included in your estate for federal estate tax purposes. So you die with stuff in your living trust, that's included in your estate. You die with an IRA, that's included in your estate. You die with an annuity, that's included in your estate. Your life insurance, the death benefit on your life insurance is included in your estate, except that you don't get an adjusted cost basis on certain classes of assets like IRAs and annuities. Those are ones where you don't get an adjusted cost basis. So they do have an income tax component. I will finish this slide with life insurance. This came up yesterday in a meeting. I was meeting with some clients and somebody made an offhanded comment that they were deducting the premium that the person was paying for life insurance, and they were in error. So I said, "Are you sure?" Because that's but this is something to know. If you take, like, you have a business and that business buys insurance for you, if you take an income tax deduction, so if you deduct that $5,000 premium payment from your taxes, the death benefit is taxable. So that's very, very important. Really rethink: do you really want to be deducting those premiums? Is it really worth it? Because that death benefit then does become taxable. Generation skipping trust. So what is a generation skipping trust? And this is a very timely slide because there's a proposal to eliminate the generation skipping transfer tax as well as the estate tax. Now, whether that goes through or not, I don't know. But if that's repealed, the entire statutory structure for generation skipping trust goes away. So if there's a big bill that comes out of Congress that eliminates death taxes, eliminates estate taxes federally, and generation skipping taxes, you are absolutely going to want to make a rush to the attorney's office, because a lot of these trusts are written and they make distributions to people after you die based on generation skipping transfer tax law and estate tax law. So it's kind of a sidebar, but if this bill passes and these are eliminated, you're absolutely going to want to revisit. It's going to be kind of the full employment act for estate planning attorneys, quite frankly. But what is a generation skipping transfer tax? This was developed in 1986. And what it says is when you die, assets are included in your estate. 13.9, the first 14 million goes tax-free. And I had this example of a mom with a $114 million estate. So that $114 million estate, if mom leaves that $114 million to her kids, $14 million goes tax-free. We're not thinking about that. But 40% of that $100 million or a $40 million tax bill goes to the government. So the kids end up net 60 plus the 14. So they end up with 74. So they're paying that 40% tax on amounts over 40 million. generation skipping trust. So what happened is people are like, well, wait a minute, we're super rich, right? We want to skip the kids because the kids are already rich. We want to give that 100 million. So grandma, in this case, wants to leave 114 million to grandkids. Well, here's what the government did in 1986. They said, hey, people are doing this, and we're not getting our fair share of the cut of the taxes, or whatever you want to, however you want to frame that. And so what they said is, if grandma leaves $100 million to grandkids, sure, that 14 million goes tax free, but you're going to pay 40% tax on the first generation, and that 60 million that's left over is going to pay another 40% tax. That's 64% tax. So $64 million goes to the government in tax. That leaves 36 million to the grandkids. So a generation skipping tax is when you have a direct skip over $14 million, right? So you have money that skips a generation. There's an extra tax. So it's taxed twice. So it's taxed, and then what's left over is taxed again. That is what the generation skipping tax is. What is a generation skipping trust? Well, instead of leaving that $100 million, I know that's a big number, but just the math is easier. Instead of leaving that $114 million to directly to the grandchild, you can leave up to $14 million that goes to your child. So the child gets 100 million, pays 40 million in tax, has 60 million. They just put that in their pocket, let's say. That $14 million that's left over, the amount that you can skip a generation is 14 million, 13.99 million. But you can put that into a trust that benefits your children for the child's lifetime, right? So a generation skipping trust, this would be called an indirect skip. This really isn't skipping the child, okay? But the child has access to this money, this 14 million. Now, if you already have 60 million, don't touch the 14, let that grow. Why wouldn't you let that grow to 50 or 100 million, right? Invest it, get the return, build that over time. But that money is there for the lifetime typically of the child. And then when that child passes away, that 14 million, whatever it grows to, it could grow to 200 million, goes to the grandkids free of death tax, either free of generation skipping tax or free of tax for that child's generation. So that's kind of what generation skipping is. And a generation skipping trust is a dynasty trust, really. So it's money that goes into a trust where the next generation, so you have parents and children, that child's generation uses the money, and then when that child passes away, goes to the grandkids. So,
and what I want to highlight
yeah.
for a moment, if we can go back to that, the reason why we really wanted to create this visual is I am having a lot of conversations with people that are planning to inherit significant wealth. And so and they already have a, potentially taxable estate. So, current client has, single $12 million estate. They're going to inherit, 5 to 10 million additional in the next 5 to 10 years, more than likely. The reason why I'm having this pre-inheritance planning conversations and we're working on their estate plan with Cunningham Legal and working in coordination is because I want to make sure that this client they know that the trust provisions that they're going to be inheriting from dad, I want to make sure that dad has a GST provision in his trust, because I don't want all of this 5 to 10 million that's going to be coming her way to then all of a sudden compound her own estate tax problem for her children. And so we can do such things as even getting the GST trust tax ID and getting certain things in place so that when he passes, the money doesn't go straight to my client. It goes to, or to the child, for example, it can go into this GST trust. My client can use money from that to go do whatever she wants to even go buy a home for her children, the grandchildren of the decedent. But it doesn't then become all of a sudden straight to her name and now compounding this longer term problem that we're going to now have an estate tax on her estate if she dies. All this money that could have been exempt from an estate tax is now all of a sudden compounding a bigger problem. So this is really where I want to make sure that if you plan to inherit, this can be difficult and awkward conversations, but to the extent that you can have those conversations and you can plan, looking at the trust documents, ensuring that they have the proper drafting, the GST provisions, to make sure that when you inherit, you can have this set up. I can't tell you how many times this is also overlooked by financial planners, CPAs, trust administration isn't done appropriately. We've had numerous amounts of examples of this where they just go, oh, I'm the beneficiary. I'm going to just go put this all in my trust, which might be fine, but it could compound an estate tax problem.
Yeah, Christina, you know what you're talking about is what I think people, because I know this for a fact. I speak at conferences. I talk to a lot of other lawyers. I talk to a lot of financial advisors, CPAs. I would
Mhm.
say 95% of the people I talk to are not thinking in multi-generational terms. They are not thinking about, you know, I'm a parent, I've got a $2 million estate, and I've got two kids. One has absolutely nothing, the other one's super rich, right? So the one
Mhm.
who doesn't have anything, we don't necessarily need generation skipping trust for that person. But the person who's really wealthy, the child who's wealthy, we would absolutely want that $1 million because they're not going to spend it. That's just going to grow to 5 million, 10 million, and it's going to be a compounded problem when that wealthy child dies. And so what this is I think it's rethinking this whole universe of wealth, which is a complete taboo subject, right? I mean, culturally, at least for pretty much every culture I can think, money is taboo. You don't want to talk about it. You don't necessarily want to ask your kid, what's your net worth? A lot of people kind of know because maybe the children tell them or they can see things. But I would say, seeing is can be really deceptive. People who are wealthy oftentimes do not outwardly appear wealthy. I think you and I know that
Mhm.
very well. But really pay attention to this. So if this is you and you're the wealthy kid, you might want to think about talking to your parents about restructuring their estate plan so that this inheritance stays out of your estate. And if you're the parent, you might want to think about your kids. I'm assuming this is, parent to child
Yeah,
inheritance.
I mean, most of the time that's what we're dealing
Yeah.
with, but it's not all the time. But it's important to have these conversations.
And it's interesting because, again, I've been doing this 30 years. There have been a lot of stocks that have gone from zero to a lot. And every time there's a big run up in a particular company, certainly being in the Bay Area, Northern California, and Southern California, you're going to get these people coming in. And we get the people who have a, $25 million portfolio of NVIDIA because they've been working there for forever, right? And now and the parents may not know that this child
Yeah.
has the wealth, right? And they're
Hmm.
still driving their Prius,
Hmm.
living in a condo. So why does this all matter?
It's important to understand, I think, to the best extent that you can. And this isn't always possible that you can plan for inheritance. And there could be, too many people are private or there's estranged relationships or, there's complexities when you're dealing with money and with family. But to the extent that you can help with a, potential, loved one that you are going to be inheriting from, what will be the income tax that will be attributable to you on those assets? What could be possibly planned for, redirected, mitigated? Is there going to be an estate tax due? Where is that going to come from? And then should certain things be done with gifting or charity and maybe looking at getting things out of the taxable estate, like doing an advancement to a 529. You can do 5 years of lump sum annual gifting. So that 19,000 per year times five per child that you're going to save for 529 college, planning, you could get that out of your estate all at once. If you're looking at a potential taxable estate, that could be a generational education legacy fund. You could be looking at creating a donor advised fund that could be a charitable fund that your family manages for distributions to charitable causes. And you could list what those causes are important to you and name successor managers of this is money I want going to charity for these causes in perpetuity. Um, Retirement, do you have a long-term care plan in place is important too, because
Very
sometimes people
important.
don't have the ability to plan for it, pay for it. It's costly to do a long-term care policy, but it's costly average $9,000 a month for care in California. Maybe you couldn't have afforded this for your retirement plan until there's an inheritance or wealth transfer. And especially if you have had to care for a loved one that is in a long-term care situation, you know how costly it is and how burdensome it is to the caregiver. So if you can afford to purchase a policy with some of the inherited proceeds, that's something that could drastically improve your retirement plan. Because if you have an event that could cost your success of your retirement plan if you haven't planned for long-term care events. So I think that those are things to think about too, is what to do with the inheritance. Is there a long-term care policy in place? Have you had to deal with long-term care recently in your family? And could we leverage that to potentially, you know, create an income stream even if we need to?
Great questions. I think, fundamentally it matters on a very high level. It's about peace of mind. In and so many people come in. There's anxiety. There's a lot of stuff that comes out. We talked about this in the beginning. When
Mhm.
someone's like maybe the last parent or maybe first parent or whatever, typically we see that a parent passes away, and there are issues between siblings quite often. And these just kind of manifest themselves. They come out. It can be a very stressful time, a very difficult time. It is better to go into a stressful situation and a difficult situation with some semblance of a plan where you've already thought through all this stuff. So, like, there's a list of 100 things to do. If you can cut that down to 60,
Mhm.
you're going to keep your sanity that much, a little bit more sanity. But
Right.
tough situation for a lot of people, and for other people, not so tough. I mean, you might have the emotional loss or not of losing a parent, and it's more mathematical on what this all means for you and your family. But great material. Thanks for joining us, Christina. This is what we're talking about here. You need an A team, and we're not talking about the '80s A team with B.A. Baracus. We're talking about the CPA, the tax advisor, the estate planning attorney, and the certified financial planner. These people should be working together because a lot of what we've talked about absolutely falls through the cracks. And I will be the first one to tell you, I don't know enough about all of what we just talked about. There's so much more. There's so many nuances. And I will tell you, each of these people brings their own training and their own viewpoint. And the idea is that together, they're going to optimize your estate plan. They're going to optimize the inheritance strategy and really not leave anything on the table.
Yeah.
One thing I do want to mention is for those of you who have an entity, an LLC, a corporation, potentially a partnership even, anything that requires registry at a Secretary of State's office, the deadline has been extended till March 21, 2025, which is, I don't know. I don't know why they picked March 21. Maybe because it's the first day of spring. You have until that time to comply with the Financial Crimes Enforcement Network Corporate Transparency Act. And if you do not comply, the fine is a little bit over $600 per day per entity. So you need to get on it. I would say for 95% of people, super easy. You can do this on your own. If you're a trustee of a trust, it can get a little more difficult. And if you just don't want to deal with it, you could certainly hire us. And there's some other third-party providers out there. But I do really want to stress, please get this done because I would suspect the government is going to be pretty aggressive on enforcing it because it literally is like 20 or $30 million companies, 20 or 30 million companies that have not complied. That's a lot of money for the government to go after. And by the way, those zeros and ones are binary for FinCEN. We looked that up, Christina.
Hmm.
We are doing an in-person workshop today. If you happen to be in Roseville at 4:30, we're going to go over a business planning workshop. I will be there live in person. And yes, I'm taller than I look on video. Next webinar, March 6th, Prop 13 in California, how it benefits us today. We're going to go through Prop 13. We're going to go through Prop 13 best strategies. This is a valuable benefit, a valuable, important property right for Californians, and you should not be leaving that on the table and do everything you can to preserve it. And we're going to go through the benefits and how to preserve that, and that will be next week. We have office locations in Northern and Southern California, and this is our contact information to contact Ascent Wealth Management, as well as I think we're at the bottom there. And we will open it up for questions. And if you're watching this on YouTube, just keep watching us because magically another video is going to roll right after this one. And please join us on our next webinar. Thanks for joining us.